Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 23rd, 2024. How you doing? I apologize that this podcast is being released late today. I'm still in Colombia, Santa Marta, Colombia. I'm really enjoying this country, and I woke up this morning and I started doing the podcast, and right in the middle of doing the podcast, my computer completely went dead, and I was scared to death, to be honest with you, because, we rely on our computers so much for trading. I have some other internet or some Zoom calls I have to do tomorrow, and just all sorts of things went through my head. And so my girlfriend and I went to a couple computer stores to see if they could help us. No luck. And then luckily my girlfriend knew someone that knew someone, and 30 minutes later in somebody's house, Manuel, here he is right here. He's working on my computer on his day off, and he said, come over to my house and I'll see what I can do. And here, my computer, he has it all torn apart. And here he's actually doing some soldering. Um, and here is kind of his, oops, wrong one here. Oh, I guess that's all I have. But anyway, he did a really great job, and he fixed it unbelievably. I just don't know what I would have done without this great gentleman. So, Manuel, thank you so much for fixing my computer, and who knows what would have happened without it. But anyway, welcome to the Gossett Trading and Mentoring Weekend Review. In this podcast, the format is as follows. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily time frame and the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, what was the strategy, what was the thinking, what were the confluences and signals that lined up for me to take the trade, and then most importantly, how am I going to manage the trade going forward in the future, whether it goes my way or goes against me. We can never control anything that the market does, but so what we can control is what we do depending on what the market does. And that's why it's so important, everyone, that you have a process, a trading process that tells you when to get in, when to get out, and it's just that simple. We're going to have a lot of losing trades as traders, and we sometimes need some really big wins to pay for all those little losing trades, so we have something left over. And if you don't have a process, it is really hard to do that. I say this every podcast, but it's important that we are very impatient with our losers and very patient with our winners. So, when I look to enter a trade, there's several things. I want to see some kind of major level rejected in my favor. I want a position size based upon the current market volatility and the balance that I have in my account. I want to set an emergency stop. I want to have a very good risk to reward ratio on my end of day stop. I want to take partial profits as the market moves my way. Once it gets to significant resistance levels, I want to tighten up my stop, go into trailing stop mode. And then there's also some higher levels that tell me when to get out of the trade. And so it's very, very important that you have a good trading process. Just somebody telling you to buy something, okay, great, but when do you get out? And when do you get out of a portion of it? And what do you do if it goes against you? And where do you get out? It's so much easier in trading to have a good process. And so, this is what I'm going to show you today. I'm going to show you my process. Not all of my trades this week are positive, but I have a process regardless, and I know exactly what to do. So, if I can help you with that, please let me know. I do teach private one-on-one lessons. I teach all of the 5 different trading approaches that I use, and you can email me. The link's in the description of this video, or you can, just go to someone else. Whatever it takes, find someone that can help you create a process, because over time, that is really what you need. Okay, after we go through the trades, I am going to talk a little bit about trader psychology. Always the most important part of trading is the psychological portion. It's really the greatest skill in trading. Creating the plan, okay, that's one thing, but then following the plan, that's the trader psychology portion. So I like to teach it. I hope it's helpful for you to hear as well. And then lastly, I have gone down through my master watch list. both on the daily time frames and the weekly time frames, and I will share with you of what I'm looking for next week, both on the daily and the weeklies. I like on the weekends to look at a chart and go, gosh, in a perfect world, if it got to this level, I think I would get in there because of this, that, and the other, right? Multiple confluences, combinations of entry triggers lining up. And anyone can do this. Anyone can look and say, if it got down here to the 200 and it was a 30 RSI and it was a negative third ATR channel, maybe we got a V1 and it looks good on the higher time frame, that would put the odds in my favor. It doesn't mean it's going to be a winning trade, but it puts the odds in my favor and gives me an edge. And so that's what I do each weekend, and this is what I share with you here on this podcast. So they're not there. Maybe they won't get there, and if they don't get there, I'll just go on to another market. But if they do get there, then I will consider taking the trade. All right, so I'll share with you, and I have some pretty good ones. It's an interesting market right now because on a lot of stocks we're up really high, on a lot of stocks we're down really low, and just based upon what the current market action is, I'm using some strategies that I don't use very often, but I'll share those with you today as well. All right, so first of all, let's run the U.S. legal disclaimer. I'll be back in about 40 seconds and we'll get started, so hang tight, please. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started on the current daily trades that I have. Okay, this is Rio. RIO. I did enter Rio all the way back here on the 29th of February. Why? Well, you can see the shaded blue box here. We gapped down, and then after the blue box, we immediately gapped up. This is what's called an abandoned baby. These are very strong signals. For whatever reason, the prior day, we gapped down, which means we opened much, much lower. Why? I don't know. There was some kind of negative sentiments, negative news, something. But then the very next day, it gaps up, leaving this bar kind of hanging in space. You see how it's kind of abandoned here? That's why they call it an abandoned baby. These are very, very strong signals because sentiment changes from negative to positive very quickly, and when that happens, that tends to go up more than it goes down. It doesn't mean it can't go down. It certainly does. But, you do that out of 100 of those, I would say somewhere between 70 and 80% of the time when this happens, it tends to move up more than it moves down. So I did get long here. When that happened, it gapped up. I didn't chase it up there. It came back to it came down and tested the high of that abandoned baby. That's a very strong level. I got long here at 61.78. So in this particular case, on these abandoned baby and these island reversals. And by the way, if you want to learn more about these, just go to my YouTube channel. I have a video there. Just type in abandoned babies or island reversals in the Gossett Trading playlist there, and you'll see that. And I go into detail more about what abandoned babies are and what island reversals are. So on these island reversals and abandoned babies, my profit and loss is pretty easy on these. I just literally set a 2 ATR stop loss to the downside, and I set a 4 ATR profit target to the upside. These abandoned babies and island reversals, like I said, the tendency if this happens is that it goes up more times than it goes down. So I'm willing to risk 2 ATRs if I'm wrong to make 4 ATRs if I'm right. And risking less than what you could make, or in other words, having an asymmetrical risk to reward ratio, lose 2 ATRs to make 4 ATRs, it's just good trading practice. Okay, so anyway, I don't scale out on these like I do a lot of my other trades. In this case, it would have been better if I would have scaled out, but still it's doing fine. stops down here, 59.27, and the profit target for ATR is up here right now about 66.41. It's moved around quite a bit, but this particular trade currently from entry to current price is up 1.97%. UNG. All right, UNG, kind of an interesting trade here. You can see this blue shaded area. This is what's called a fair value gap. And all the way back here on the 20th, I did the podcast around here, and I said if we move up strongly and change market structure, and then we come back down into this gap, most likely I'll buy. I didn't buy here. I was waiting for it to get to the very bottom of the gap, about 1494, and it just took off without me. But it does go to show you that these particular trades, the low, the lower low, the change of the market structure to the upside, and then the pullback to the fair value gap, that was a nice run. Unfortunately, I didn't get it. But here I said, if we do get back down into the fair value gap, I will buy UNG. And we did. Here on the 13th, I got long at 1488, right when it touched the top. I'm not used to speaking English. The top of the order block down there at 1488. And so it did come down here, really got the bottom. The next day we moved up nicely, where I did take some profits. I always take profits if it moves the value of 0.45 ATR from the previous bar's close. As we get into some other trades, I'll get more specific about that. But the next day it did move up nicely, and I believe I hit 2 profit targets. My stop is simply a close below the low of the order block here, and my 2 ATR stop is all the way down here. So we moved up. I took some profits. Next day we came down. We didn't close below my stop. Moved up, and then the last 3 days we just kind of moved downwards. But I'm still bullish on this trade. It is positive currently, 1.46%. But when I get into taking the partial profits, you'll see why it's such a good idea. Whenever the market moves your way nicely, it's always a good idea to take some off the table. Reduces your position size. You lock in that money. The market can't take it back away from you. But so again, the stop here is below 1454. Emergency stops down here. If we do move up to this orange line here, I will go into trailing stop mode, which just simply means that then, if it does get there, if I have a close below a previous bar's low, I will exit half the position to lock in more profits, mitigate, because once it moves up here, and if it does close below a previous bar's low, well, it's more likely to head back down. And so once it moves to 1.5 ATRs, I tighten up the stop. That's just good trading principles, okay? So UNG up 1.46%. All right, Pfizer. Pfizer, you can see here, highlighted in blue box here, the 2 bars. This is an island reversal. Remember, an abandoned baby is only 1. Island reversal is 2. Took off here. And I didn't buy it here, and it just ripped higher. And I was like, dang, those island reversals are strong. But came back down into a fair value gap. And again, this is something that I teach. This is the ICT trading strategy. But there was a fair value gap. Here's bar 1, 2, and 3. The high of bar 1, the low of bar 3. This is an area in here. I'll highlight it. This is a fair value gap. This is where the market, if it pulls back, should stop. And that's exactly, you can see, it came down and exactly stopped right there. I did get long here on Pfizer right when it touched the bottom of that order block. And right there at 27.36, it bounced. So it moved right up as soon as I bought it. Next day, stayed about even. Next day moved up. I did take a partial profit off, reduced my position size a little bit. And right now, let's see, we're at 27.36. Price is at 27.36, so I'm exactly still even on the trade. Once I get to 1.5 ATR trailing stop level up here, and I will go into trailing stop mode. My end of day stop is simply as close below the swing low here at 26.75, and the emergency stop is always at 26.12. So completely even on this particular trade, Pfizer. And by the way, everyone, I'm also going to talk a little bit about some day trades that I've been taking. I've been posting those on Twitter. I've had some viewers email and ask me if I could show them some of the day trading that I do, because I do day trade all day long. And so I'll share I'll share a day trade with you as well. It's on NVIDIA, and then we're also going to talk a little bit about the markets, the general indexes like the Qs and the SPY as well, just to kind of get an idea of possibly where this market's going. TLT, which is bonds, I did buy this here on the 21st of March, which was Thursday. Why did I buy this here? Well, this was a move back down, sideways motion, and a V2. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. And we had the sideways motion previous to that. And so I did get long here, 93.06. I position size here based upon volatility. At least my emergency stop is always 2 ATRs below. And then my end of day stop, your end of day stop on a V1 or a V2 is halfway of the washout bar. And the washout bar was this second bar here, the V2. Bar 1, bar 2, bar 3. You see the line here is halfway of that washout bar. If Monday we simply close below this line, I'll simply get out of the trade. But luckily, Friday took right on off for me, moved up strongly, moved up 88 cents, or actually more, at the high. And so I did take 2 profit targets. I got out of 20% of the trade when it immediately gapped my way, and it's closed back below the open here, but it was nice to get out of 20% immediately and reduce my position size by 25%, because if it does go back down, it's going to really help mitigate my loss. Orange line up here is my trailing stop level. If I do get up to trailing stop level, then I go into trailing stop mode, which again means that if I have a close below previous bar's low, I will simply get out of the trade. So this trade, being that it's the first day that I've taken trade, up pretty good, up 9.95%. And then UUP. All right, UUP. Well, I have been waiting patiently for the market to come back to this level. You can see highlighted in blue, this is a island reversal to the downside. You see how we gapped up? We had one day kind of sideways, and then we gapped down. So we went very strong news to very bearish news. Well, this is an indication that more than likely it's going to go down. The next day it came right to the bottom of the island reversal. I missed the trade. I just simply missed it. I would have shorted here, and you can see that would have been a wonderful short, but I didn't get it. And so on Thursday, we got back right to the bottom of that island reversal. So I did get short here, 28.17. Abandon baby, island reversal. I use a 2 ATR stop to the upside because this is a short, and 4 ATR to the downside for my profit. But there was some news that came out about the Swiss franc, and that drove the dollar immediately up. So this one's not looking so good so far. This particular trade here is down 0.53%. If it gets up to the red line there, that's my 2 ATR stop. I'll simply get out, take the loss. That's all there is to it. So one of two things are going to happen. It's either going to hit this green line or this red line where I'll lose 2 ATRs, or if it heads back down, I'll just wait and wait and wait till it either hits the red line or hits the green line here. And again, why go short? Well, this island reversal over here, it's more likely that it's going to go down when that happens and you revisit this, but you never know. You know, that news on Friday could have changed it, but you know, we're not going to win every trade. The key is, though, I mean, I have a lot of losing trades, but the losing trades are always smaller than, not always, but more than often, they're smaller than the winning trades, and that's the key. That's how you make a living trading. That's how I've made a living trading for over the last 28 years. It's not by being right all the time. It's just making more money when you are right and losing less when you're wrong. So this one down 0.53%. So just a real quick recap on the dailies. Rio up 1.97%. UNG up 1.48%. TLT completely even. Pfizer completely even. TLT up 0.95%. And UUP down 0.53%. Okay, let's go over to the weeklies. The weekly, I take weekly trades on Friday because that's when the weekly bars close. This was a bummer trade because I waited months and months and months for this, and it was a great setup. I got long VIX 2 weeks ago at 1408. A lot of reasons to be bullish on VIX. We keep going down. There's bullish divergences. We had a V2, bar 1, bar 2, bar 3. Bar 1 goes below, bar 1's low, bar 3 closes above, bar 1's close. Got long at 1408 and the signal was an under 30 the previous week, and then it closed over the 30, so giving me an under 30, over 30, plus the V2, plus the double bottom bullish divergence. I mean, if I'm not going to take this trade, I don't know what trade I'm going to take, but just goes to show you, no matter how good your trades are, it still doesn't matter. The only saving grace is that on the week that I bought it at 1408, it did move up much higher than that, and I did take a little bit off. So again, that's why I like taking partial profits, because if you're wrong, those little partial profits that you took mitigate the actual end loss that you have. So the next week, it did go down a little bit, but it held above the 30 RSI. But this week, it gave up. You can see right now the RSI level is at 2890. Obviously, that's under 30. So it untriggered, the 30 went under 30, over 30, back under 30. I have to get out of the trade for a loss of 7.01%. And you might ask, did you lose 7.01% of your money? No, because the worst case scenario for me, or almost the worst case scenario for me, is that I position size based upon the volatility of the market using a 2 ATR. Right now, the 2 ATR is $2.58. So I take 1% of my total capital, I divide it by the value of the 2 ATR. That shows me how many shares to buy or sell, and then I place the emergency stop, exactly that number, 258, below my entry. So which means that had this gone all the way down here and turned into, I don't know, a 21% loss or something like that, all I would have lost is 1% of my capital. I know 7% sounds like a lot, but it's, roughly 1/4 of 1% of my capital that I lost on this trade. So sometimes the percentages can seem really high or really low, but if you're position sizing correctly, really most of the time, almost worst case scenario, it can gap below there, obviously. But about 95% of the time, your end of week or end of day loss is going to be much less than 1%, because your maximum emergency stop, if you hit that, then you're only at 1% of your total capital. So this is, maybe 1/4 of 1%, even though the percentage is high though. So anyway, next week, again, I'm still looking at potentially getting in VIX. I mean, just because you have an entry and it untriggers, if it triggers again, I always take that trade again, because that's, a lot of times that's the one that you're like, I lost on it last time, I'm not going to take it this time. Well, I've seen too many times where I had that same mindset, and then the next one I don't take, and then it rips higher. I was like, I guess I was originally right. So on VIX, the weekly trade, a loss of 7.01%. XLF, all right, I've been talking about this trade for a long time, everyone. And why? Well, again, if I'm in a trade for a long time, that means I'm profitable on the trade. Because when I'm wrong, I'm usually wrong very quickly and out. So let me take you all the way back to almost exactly a year ago, minus 1 day. I got long XLF, which is the financial sector ETF, with rejection of the 250-week moving average. You see the purple line down here? During the week, it went below, closed back above. That was my entry point at 30.71. I position size, placed my emergency stop 2 ATRs below. I placed my 1.5 trailing stop level 1.5 above. Why did I take the trade? Because of the rejection of the 250 week moving average. Therefore, if it closes under the 250, I'll simply be out of the trade. Next week, moved up, took some profits. Next week, sideways. Next week, moved up again, got to my trailing stop level. Now I'm in trailing stop mode, looking for a close below a previous bar's low. Never happens, never happens, never happens. We move up a little bit, move up a little bit. Then here on the 23rd of June, we have our first close below a previous bar's low after reaching trailing stop. So I did sell half of my position for a gain of 6.4%. Then we had another 5 or 6 weeks straight up where I continued to take profits. And then we had a few months of straight down. And on this week here on the 27th of October, you can see during the week we poked our head below the 250, but we closed above. That's what kept me in the trade. That, my friends, is what I'm talking about, having a process to tell you, because I remember back here, things were not looking good. All the news was bearish, blah, blah, blah. If I would have listened to the news, I would have gotten out of this trade. But because I have a process, it kept me in the trade simply because it closed over the 250 and I follow my rules. And then look what happened from there. Huge move up, took profits. A couple weeks later, up more, up more, up more, little bars, little bars, little bars, little bars, little bars. But we continue to go up and up and up and up. So where am I going to get out of this trade? Well, I have multiple rules that tell me when to get out, but right now we're so high, it's very easy. Do you see this 5 EMA, this 5 weekly EMA? This is what I'm keying everything off. If I get a close below that 5 EMA, I'm simply going to get out of the trade. I'll be done with the trade. This particular trade, doing nicely. The remaining shares on this particular trade, up 25.71%. Again, you need these kind of trades every once in a while to pay for all those little losers that you're going to have. But to stay in a trade like this, you need a plan. You need a process to tell you, oh, it doesn't tell me to sell yet, so I won't sell yet. I mean, I would have been thrilled to have gotten out here. I mean, very likely I could just go, oh man, I'm out of here now. But my process kept me in. So this one up 20, the remaining shares up 25.71%. Okay. Last trade here. Johnson & Johnson. I'm missing something here. Let's go to Johnson & Johnson here. All right, I did get long Johnson & Johnson here on the 15th of December. Why? Well, look at the black line here. This is the 200-week moving average. During the week, we went below, closed back above. We also had a V1 entry signal. Got long, 154.27. Position size correctly. Placed my emergency stop 2 ATRs below. My end of week stop simply a close below the 200. I placed my 1.5 ATR trailing stop level above. And again, if we move up the value of at least the value of 0.45 ATR, I will get out of part of the position. A couple weeks we moved sideways, then we had a nice big bar up, took some profits off the table, had another bar up, got to trailing stop level. A couple weeks later, we have our first close below previous bar's low. I got out of half of the position for a gain of 3.33%. Then we had a few weeks of just moving sideways, followed by a big up bar, which again, I took more profits, reducing my position size. And then the last month, we've just simply gone down. But, you know, if the black line here is my end of week stop. Next week, if we close below this black line, I'm simply out of the trade. Currently, the remaining shares on this particular trade, not up a lot, up 0.66%, but you can see the value. Next week, if it does close below and I have to get out, you can see the value of me taking partial profits at much higher levels, and that's the value of taking partial profits. Okay, I'm going to hit pause here for a minute because I'm missing a trade here that I want to share with you. So hang tight. I'll be right back. Okay, good. I found it. I think when my computer died this morning, it somehow took it off or something. Here we go. I did get long CCJ yesterday, Friday, the 22nd of March. Why? This is a perfect example, everyone, of a return to value V2. These are great, great setups. Go to my YouTube channel, look for V1, V2 setups. I use V1s, V2s all the time as a enhancer to any other trade I take. Under 30, over 30, something like that. If it has a V1 or a V2, it makes it even better. But I don't usually just take a trade based upon a V1, V2, unless it's a return to value V1, V2, or a higher low V1, V2, which I teach both of these in my one-on-one course. But this is a perfect example. Look at the green line here and the green line below. Anywhere in between the bottom of this one and the top of this one is called the value zone. You want to get in the habit of buying in value and sell above value, or buy below value and sell in value. Too many people buy above value and then sell when it gets back down to value, which is generally the time that you want to buy it. So here we are above value. I'm not going to mess with it here. We come back down into the value zone. That's the first requirement. We have to close above. Second, we have to come back in. Third requirement is we have to move sideways to show that there is some equilibrium between buyers and sellers. And then when that happens, we're ready to get in the trade if we get a V1 or a V2. Well, Friday triggered a V2. Bar 1, bar 2 goes below or washes out bar 1's low. And then bar 3 closes above bar 1's close. See the little V that it makes? That's why they're called V1s and V2s. But this is a perfect example of above value, return to value, sideways motion, V1 or V2 trigger. This one was a V2 trigger. Got long here, 42.80. I position size correctly. I placed my emergency stop 2 ATRs below, and then my end of now this is weekly. My end of week stop is simply a close below halfway of the washout bar. The washout bar is the day 2 bar that goes below bar 1's low. So you can see the line here. It's pretty good risk to reward ratio, right? So next week, if it closes even 1 penny under there, I'm simply out. If it comes crashing down and gets to my emergency stop, I'm simply out. And if it does, then I lose 1% of my account, right? If it goes up the value of 0.45 ATRs, right now it's 1.61. If it moves at least that much next week, I'll take 10% of my shares off. If it moves double that, I'll take another 10%. If it moves triple that, I'll take another 10%. If I get to my trailing stop level, then I go into trailing stop mode. And then once I get into the 65 RSI level, then the 5 EMA comes into play. If we reject the 70, then I take some action there as well. So this particular trade, and I'm getting in this trade a little bit late because if you watch my podcast, I said right about this area is where I want to get long. And I should have obviously taken this trade when it bounced at the 200, but I didn't because of this big bar. That scared me away from the trade, unfortunately, but it would have worked out really great. So I'm buying it higher, which is fine, but we did get over this bar here, so it kind of changes the dynamic. So this particular trade did take on Friday. This up 0.95% already. So quick recap on the weeklies. VIX, my biggest loser there on the weekly trade, minus 7.1%. XLF remaining shares up 25.71. Johnson & Johnson remaining shares up 0.66. And CCJ, the new trade, up 0.95. Okay, so listen, before we take a look at next week's trades, I would really appreciate if you wouldn't mind hitting the thumbs up button. I always forget to mention this, but everyone tells me that if you're enjoying this so far today, if you find it of value, if you could subscribe or hit the thumbs up button, I really would appreciate it. It really helps out the channel a lot and lets YouTube know there's some valuable content here. Okay, this is from Trading Composure. Really good channel over on Twitter. You can follow him at Trading Composure. And this, I had a phone call yesterday, with a friend of mine who's a trader that's really been having a hard time because they are short the market. Um, and there's a lot of smart people that are short the market right now. And obviously, this has been a melt up, historic melt up, and they're really getting hurt. And bears can make all sorts of cases of why we shouldn't be here. And honestly, I'm kind of in that camp. Honestly, I really am. But the market really doesn't care what I think or anyone else thinks. It's just it does what it does. And my friend has really gotten hurt by this market, by being short and staying short. And honestly, I don't blame them from a fundamental standpoint. But they they're really in bad shape, really in bad shape. And I've been there, and I know what that feels like. So when I read this, it really reminded me, especially based upon what I'm going to say. Rock bottom can lead to growth. It breaks barriers, strips egos, and offers insights, emerging stronger. Everyone should have the experience of being depressed and hitting rock bottom at least once in their life. I really think that it's an important part of growing up. It cracks you open like a shell, destroys your ego, and teaches you a lot about yourself and life. And unfortunately, that is kind of what my friend is going through here, from being beat up after 4 or 5 months of getting their butt kicked every single day. And why do I bring this up in relationship to this post? Because what they told me yesterday was that, you know what? I am just going to trade the technicals based upon what the technicals say, and I am not going to overlay my bias onto this market anymore because it's not working. Um, that's kind of ego shattering and saying, okay, I'm wrong. I'm just going to follow the process. And honestly, if you begin trading at one point, you may go through this and learn from other people what they've been through. You can learn it from other people, or you can learn it yourself. But in my opinion, it's always best just have that process, trade the process, even if it goes against your opinions and your views on the market. Because the market doesn't care what you think. The market's going to do what it wants to do. The market's always right, not you. And if you have a process that tells you, okay, you're wrong, get out, even if your opinion is opposed to that. I've seen it many times in my trading career. I've dealt with it in my trading career as well. And so hopefully you can learn from this. And like I said, you can either go through it yourself or you can learn from other people. And my best advice to any new trader or experienced trader out there, get yourself a process and just follow it, even if it contradicts what your opinions are on the market. If your opinion is the market should go up, but it keeps going down, don't get in until you have a signal that tells you you're going up. If you're a perma bear and you think this market is going down, wait for signals or indicators to tell you to confirm instead of sitting in there and just getting your butt kicked to the upside. So, and I am going to talk, like I said, a little bit about the markets, and I am starting to see some proof that we probably are very near a top. But I'm proud of my friend for going, you know what, I'm wrong. I'm just going to trade from technicals now and, forget about my bias and my opinions. And that's a tough thing to do. And, I'm proud of them for doing that. So when I saw this post, it really kind of hit home. Rock bottom can lead to growth. It breaks barriers, strips egos, and offers insights. And if you want to be a trader and a profitable trader over the long term, you got to strip your ego. It really comes down to that. So thanks a lot, Trading Composure. Great post. All right, let's go through some potential trades for next week. And once I get down into NVIDIA, I'm going to show you a day trade as well that I took And it's relevant because what's going on with NVIDIA on the daily is exactly the same reason I took the trade on the 5 minute. Okay, let's start on the dailies with Adobe. Well, okay, obviously Adobe had earnings and they were not good. And we came all the way down here, bounced at the 300-day moving average. This would have been a legitimate trade. I decided not to get involved because it was right after earnings. But you see the orange line. This is the 300-day moving average. During the day, we went below it and closed back above. So that is a legitimate trade with close below the 300. And it, for the next 3 days, it would have been a profitable trade. But what I'm looking for, and I'm only going to get involved in Adobe if it gets down here, is another test of that 300 moving average, the orange line here. We're to 34.95 RSI. If it does come back down there, we very well may retest the 30 RSI and retest the 300 at the same time. And like I always say, the more confluences and combinations of indicators that you have lining up at the same time, the better. So I don't know if it's going to come down here. If it does come down here, bounce at the 300 or intraday reject it or close below it and close back over it, I may consider getting into Adobe because I like that it bounced there the first time. And like I said, these are the type of things that I teach in my one-on-one course. So, if you're interested in learning to trade correctly from a trading professional, I've been trading 28 years, consider working with me. It's a 15-hour course. We do 3 hours per session, 5 sessions. We do 1 session per week. We record the call so that you always have that as well. And, I've taught people from all around the world, all from complete beginners all the way up to hedge fund managers. So, if that's something of interest to you and working with me, just send me an email and we can get the process started. So again, Adobe, just looking for a rejection of the 300. Doesn't mean if it rejects it and I take it that it's going to be a profitable trade, but I did wait for a major level to be tested and rejected and giving me a good risk to reward ratio. And that's about all you really can do. So Adobe right here retested the 300. ARC Innovations. Okay, well, ARC is the Kathy Woods Fund. And you can see on Friday, we created an abandoned baby. Wednesday, moved up. Thursday, gapped up. Friday, gapped down. So we went from very bullish to very bearish within a span of 2 days. This, to me, indicates that we are heading lower on ARC. I'm not going to chase it down here because the risk to reward ratio is not good at this point. But the key resistance level, if it does head back up, will be the bottom of this island reversal. Of the abandoned baby here at 50.48. So next week, if we go back up, get to this 50.48 level, there's a possibility I will get short ARC. I'll place a 2 ATR stop above and a 4 ATR profit target below because it's an island, or it's an abandoned baby in this case. If it keeps on going down, oh well, I missed the trade. But again, next week, if it does come back up here, ideally reject the bottom of that abandoned baby at 50.48, I will consider getting short. And you may say, why would you consider it? Well, I have 7 symbols here. Technically, next week, all 7 of them could trigger, and I'm not going to take all 7 of them. I have a rule that I only take the best one of the day. So if these all triggered on Monday, for example, then I have to narrow those 7 down to the best one. And how do I do that? Well, I have to take many things into consideration. Which one had the best risk to reward ratio? Which one had the multiple confluences and combinations of signals? Which one looked the best on higher time frames? Which one had the strongest or the weakest relative strength? Right? These are all the things that you need to think about. And for me, it's worked very well for me to not get caught up into buying 3 or 4 or 5 positions in the same day. I just narrow it down to the best one of the day based upon how I trade. So even if it does get back up there, doesn't necessarily up to 50.48 doesn't necessarily mean I'm going to short it, but potentially I would short it because some of these other ones may be better. So ARC, if possibly up at 50.48, if it goes back up and tests the bottom of that abandoned baby. Boeing. Okay, Um, what I'm looking for on Boeing here, we have this huge move up here, and here's bar one, bar two, bar three. The top of bar one, the bottom of bar three, here, the highlighted blue area is called the fair value gap. We have not tested any of these levels. On that big day up, all we did was go straight up. There's a good chance that the market will come back and test from 187.30 down to 182. And if it does, what I'm just going to be very patient on this one. I'm going to see if it comes back down to 182. It's $6 away. I don't know if it's going to get there, but if it does get there, it will be the bottom of the fair value gap. Makes sense to me that that would be a good place to potentially get in the trade. I would position size. I place my emergency stop 2 ATRs below. My stop on this particular trade would just be the close below the low here of the low. That'd be my end of day stop. So again, I don't really think it's going to get down there, but if it does get down there, it would be a really good place to buy at the bottom of the fair value gap with a good risk to reward ratio. So we'll see. Anheuser-Busch. All right, I've been talking about Anheuser-Busch for several weeks here, and previously, I don't know, was that a month ago? I was saying this area right in here would be my buy area. Well, it did get into the top of that one before it took right off. Last week, I said again, this would be the area to buy, but I'd like to see it some kind of rejection of the 200-day moving average. Well, look, the black line is the 200-day moving average. So I'm considering getting into Budweiser if next week we have some kind of rejection of this black line, which is the 200-day moving average. In addition to that, you can see this gray line here. This is the negative third ATR channel. About 92% of prices stop going down here. So you have this confluence of the 200-day moving average, which is a strong level anyway, and the negative third ATR channel nesting right here together. But I want to see price try to go below this 200 and fail, and then I would consider getting long Budweiser. Okay, McDonald's. Very similar to Budweiser. Two important levels here. Here's the 250-day, the 200-day, and the 300-day moving average. Next week, if we come back down and test this 200-day moving average, what I like about the 200-day or the 250, it's right in the middle of this big up bar. So from a Fibonacci standpoint, a 50% fib level, that coincides pretty nicely with the major moving average here at the 250 and the 200. So we'll see what happens. I don't know if it's going to get here. It may just continue up. I kind of doubt it. But just some levels for me to look at next week to potentially take a trader, the 250, 200, or if it even goes lower, the 300-day moving average. NVIDIA. All right. Everybody's favorite. All right. So NVIDIA is the stock that can never go down. But I am starting to see some interesting things here. And again, we're looking at the daily. You can see I have some levels here, but that's the day trade that I'm going to show you. Way back here, when we made that top on NVIDIA, was on the 8th of March. And the red line up here is the top of NVIDIA. Then we had a huge reversal. Well, this is significant technically that we went this high and then this low with the bearish engulfing bar to the downside. I remember telling people I wouldn't be surprised if we head back down and then attempted to rally before we head back down again. Well, we did quite that, but now last week we had another big week up on NVIDIA. But I want to bring your attention to the MACD bars. These are the green lines and the red lines here. You can see at the top of this back on the 8th, you can see how high the green bars were. This meant that there was a lot of buying from a MACD momentum perspective. If and only if next week we go back up and test these highs of 974, I can already tell from a MACD perspective that we will be at an equal high to this, but there will be most likely no green bars whatsoever. Or if there are green bars, they're going to be much less high or shorter than these tall green bars. This would indicate a double top with a bearish MACD divergence. And so next week, just for the swing trade here, next week, if we do go up and reject, which means we get right to it and come back down, or we go above it and then come back down. That would be rejection of the previous high. Overlay that with the double top bearish MACD divergence. I would certainly consider getting short NVIDIA if that happens. Now, so that's the swing trade that I'm looking at. A test of the high of 3824, only because double top bearish divergence. We have other things too. Look, here we're at the 6th ATR channel. If we get up here, we'll be at the 3rd ATR channel. Here we'll have RSI much, much higher. If we get up here, RSI will be lower. So we have a triple bearish divergence, MACD, ATR, and RSI. You have the trifecta of bearish MACD or bearish divergences, but you still need the trigger. The trigger for me, again, would be the rejection of the high. I would consider getting short, position sizing, placing my emergency stop 2 ATRs above. My end of day stop is simply a close below that high. That'd be it. So the risk to reward rate, I may be wrong, but the risk to reward ratio would be pretty good, especially with the MACD divergences. So now let's switch. So get this in your head, right? Here we have the high, green MACD bars. We may go higher here. No green MACD bars. That's what's keying me off to this particular trade. Let's get to the 5-minute bars and let's take a look at the trade that I had on the 5-minute bars on Friday. All right, here we go. This was the high on Friday, 5-minute bars. This was the high. Look at the green MACD bars, pretty tall, right? Then we pull back. Here, do you see how we tested that high, but then closed below? But look here at the MACD bars. We are higher here than we were here. Therefore, if this was healthy, these MACD bars should at least be equal to or higher than these bars, but they're not. Go back to the daily, right? Here's a high, green MACD bars. If we get up here, even if we get there, you're most likely not going to have any green MACD bars. So switching back to the 5-minute, it's the same, right? So I got short here. Oh, erase my line. Well, I got short here, right about here, 946.50-ish, somewhere in there, because it tested that high, closed back below that high. But the reason I got short was because, look, this high, no green MACD bars, exactly what you're seeing on the daily. Doesn't mean it's going to work out the same, but it's possible. But to finish up this trade, again, rejection of the high, along with the double top bearish MACD divergence, bearish ATR divergence, bearish RSI divergence. Look at the RSI here, how high it is. Look at the RSI here, way down here. So higher, but lower. MACD, higher, non-existent. ATR, 4 ATR channel here. Here, 1 ATR channel. That was the reason I shorted right here about 946.50. If it's simply the next bar had closed above, I simply would have been out for a very, very small loss. But look what happened. Immediately down. Took some profits here. Took some profits here. Here, I got to trailing stop level, closed above the previous bar high, got out of half. Got out of half right here, but still for a nice profit. Then for the next, I don't know, hour and a half, 20 minutes, something, just down. Every time I have a big down bar, took some profits, and then here, I was lucky to get out at the bottom. Why did I get out at the bottom? Because we were getting close to the negative third ATR channel, and we were getting close to the 30 RSI, which is, if you're short, is a good time to get out. And fortunately, I nailed the bottom, so that was a really good trade. I mean, from the remaining shares that I had there, that was up 1.21%. Just based upon these divergences. It's very simple. Here you have a high, tall MACD bars. Higher high, no MACD bars. Rejection of that was the trade. So anyway, hope that was helpful on the day trade there. And now let's get back to U. U is the last Unity software. U is the last potential daily trade. What am I looking at for U? Well, here we have a low. We have a lower low. This is a swing high here. This bar here on the third. Big bar up. Change market structure to the upside. We have a low. We have a swing high. We have a lower low. We have a big move up. That changes market structure to the upside. I need to wait one more bar to show me where my gaps are. And I say this a lot, but when you've changed market structure to the upside, almost ironically, as soon as you change to the upside, you have a bit of a pullback before sometimes it has a big move up. So that's what I'm looking for. The structure has changed to the upside, but I'm waiting for it to come down and to fill this gap up. Here's bar 1, bar 2, bar 3, top of bar 1, low of bar 3. We are in the gap right now. Technically, that is legit to buy, but I'm just going to be patient on this one and look for the low here of 26.10, and that will be my entry. I'll position size, place my emergency stop 2 ATRs below, and today stops simply a close below that low. So like those setups a lot. Let's switch over to the weeklies now and see what we got cooking on the weeklies. Adobe. Well, I talked about Adobe on the dailies as well. This one's pretty simple. This was from the daily chart. I like this level right about here on the weeklies because of the confluence of signals here. Adobe's a big company. They didn't do so well on the earnings, obviously. But look, here we have the negative third ATR channel. We have the 200-week moving average. This is a nice confluence here. So next week on the weeklies, if we go down, bounce at the 200 and the negative third, or intra-week reject both of them, I will definitely consider getting long Adobe with a rejection of an important level and a good risk to reward ratio. Lockheed Martin. All right. Lockheed Martin has been very, very strong. I am looking for I'm looking for a potential short on Lockheed Martin. Looks pretty strong. Why would I do that? Well, this is a fair value gap to the other direction, to the short direction. Here we have a high. We ran the liquidity to the high. We broke strongly to the downside. The top of that fair value gap is here at 450.30. It's only 5 points away. If we go up to that level, I will consider shorting Lockheed Martin, because more likely than not, at that point, it probably will head back down. I could be wrong. Could just completely go right back up, but I know exactly where my stop's going to be. So first of all, the level that I'm looking for is 450.30. I'd place my 2 ATR stop above, and my end of week stop would simply be a close above this high, because if we get above this high, then it changes the whole structure of everything and puts us back into a bearish market structure. But right here, right now, Lockheed Martin, this looks like a short to me, and I'll potentially take that short at 450.30. Virgin Galactic, SPCE, remember this one? Well. This one's not looking too hot tamale, but there are some interesting things that I see on SPCE. First of all, we are at the previous, where'd my bars go? We are at the previous level. Last time we were down here, for whatever reason, the market rallied strongly. My gosh, it went from $1.30 up to $2.74. It almost doubled from this level. Is it going to do it this time? I don't know. But what jumps out to me right from the beginning, look at this low here. Look how deep these bars are, these red bars are. MACD. Then we rally. Now we're back here just as low as we were before. No red bars whatsoever. This is called the double bottom with a bullish divergence. We have ATR divergences here. We have RSI divergences here as well. Okay, this doesn't mean to just because we have divergences and bullish divergences and I'm going to jump in the trade, but I need but I still need a trigger. I like that there's bullish divergences, but I need a trigger. What's my trigger? Well, currently we're at 32.44 RSI. I would simply look for an under 30 over 30 like I did on VIX. VIX didn't work out. It had a lot of good things going for it as well. So they don't always work out, right? But if I position size conservatively, I'm very happy to take the trade. So to sum up on SPCE Virgin next week, we have to have some kind of rejection of the 30 RSI, meaning that during the week maybe it gets to 28 or 29 and then closes back above 30. If it does, I'll consider entering. If I then in the future get a close below previous bar's low, I'm simply out of the trade. But if I'm right, I could have, it's going to go back up here. I don't know. Maybe. You never know. If I knew, I'd load the boat up, right? But I don't know, so I just trade the process. But I like the double bottom bullish divergence and just looking for an under 30 over 30. Last one is Tesla. Oh, jeez. I was drawing all my trend lines for my other trading, day trading. Okay, so Tesla's had a really, really tough time of it, but what sticks out to me here is the third ATR channel, negative third ATR channel, and the 300-week moving average. I like the confluence here. It doesn't mean that it's going to bounce here. It doesn't mean that if it does bounce that it's going to head back up. You just don't know. But I like the levels, and we're at a 37.08 RSI. So if it does get down into this area, like maybe 152, 159 area, we'll have a low 30 RSI level, we'll have the negative third ATR channel, and we'll have the 300-week moving average. So I'll just have to see, right? But earnings are coming up. I never hold through earnings, so even if I do get in this, I'll probably only hold it for a couple weeks, maybe possibly get some buying into earnings, but who knows? Who knows? But I like the confluence of the 300-day moving average and the negative third ATR channel. All right, let's talk about the market in general. Let's just look at the NASDAQ and then let's look at the SPY. And again, everyone, if you're enjoying this today, if you're finding any value from it, if you could hit the third ATR channel, if you could hit the thumbs up button, I really, really would appreciate it, everyone. It really does help out the channel, and it's quick and easy and free to do. All right, so let's look at the cues. Okay, so I was talking about NVIDIA and the double tops, bearish divergences, and why I am quite bearish in this market, right? If you read the headlines, everything's bullish, 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 but what's going on underneath the hood? First of all, it's very, very clear. Look at the highs we had over here. We had a little green. Then we pull back. Then up 2 days ago, we were higher. No green whatsoever. Let's back it up. Okay, I studied with Dr. Alexander Elder, and bullish divergences, bearish divergences, in his opinion, one of the strongest technical indicator approach to trading the markets. He thinks it's the most powerful, and this is so clear. Look at the high we have here. Very strong MACD bars, green MACD bars. We go higher, still green, but a little less. Higher, still green, but a little less. Higher, not even green. So we're going higher, 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 and buying momentum's going lower, 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 non-existent. I rarely see these be wrong over time. Next week, we could still go up. I mean, look at this trend line. You connect this high to this high, go on up here. It could still surprise and go higher. But it's not going to change the fact that we probably are not going to have green MACD bars. So I think we are very late in this move up. Yes, we could certainly get up to here. We certainly could. There is no doubt about it. But these divergences aren't lying from a MACD perspective. So this is really what makes me quite bearish. But it doesn't mean that I'm loading the boats with shorts. All it means is that it's something for me to consider. And, my recommendation is be very careful, because what I'm seeing here doesn't, just because you have the divergences, it doesn't mean it has to go down tomorrow. But over time, these divergences usually don't lie. It's just a matter of when. So I would please be very, very careful, because these divergences are very, very strong right here. But it may take something, bit of news, politics, something. But when this does go down, I think it's going to go down pretty hard and pretty quick. All right. And so that's the cues. SPY is a little stronger. But the other thing I see on SPY here, look, again, we're going higher and higher and higher. And compared to these MACD bars over here, this is pretty anemic. It is stronger than the NASDAQ, but it's still pretty anemic. And then on this long-term trend line here, here's a high, here's another high. We draw that out here. Yes, we could go back up and test this trend line here. It's possible, but I think it's running out of steam, and I think it's running out of momentum. But I could be wrong. I'm wrong very, very often. So I hope that helps. Hey, at the beginning of the podcast, I talked a little bit about my one-on-one course. I love to teach. I've taught people from all over the world. I think the best way to learn anything is one-on-one with an instructor, and that's why I offer my lessons, 15 hours. I teach you all of my trading strategies, step by step. We go through them. We do a lot of simulation trades, and when you're done with this course, I know you're going to be a better trader. The course does cost $1,750, but in my opinion, it's worth every single penny. So if you're interested, just send me an email. As an alternative to that, I have a really good online course available at udemy.com. The link is in the description, where I teach you the deep dip buy stock trading strategy. It's very, very affordable, and that course is about 9.5 hours of video, 15 study guides, 26 lessons. And in that course, I just teach you the one of the 5 strategies that I use. But it's a great place to start. Again, if you like the podcast, I would appreciate you hitting the thumbs up button. Really does help out the channel a lot. I want to thank Manuel again today for inviting me into his home and literally fixing my computer. I don't know how he did it. I walked out, told my girlfriend, I said, I can't believe he did this. I just cannot believe he fixed it. The guy's like a master. And then I always leave off with, please try to go out and do something nice for someone today. It would really make the world a better place if we all did one nice thing for another human being. If you could also be so kind and try to do one nice thing for an animal today, they would appreciate it. I would appreciate it. It's going to make them feel good. It's going to make you feel good. And yeah, that's it. I'm going to be leaving back to the States next week. Really, I really have a heavy heart about it. I really like it here. I really like the people. I really like the laid back vibe of the place and the warm weather. But I guess I have to get back to reality. But if you're ever considering visiting Santa Marta, you should do it, because it's really great and really fun. So I hope this was helpful today. If you have any comments or questions, please leave them in the section below. I'll do my best to get back to you. But I hope you enjoy your Sunday. Again, I'm sorry that the podcast was late, but I explained why with the computer problem. And God willing, next week I'll be back in the States, and I'll be doing a podcast from Utah, where it's cold. So anyway, be good, be careful, get yourself a process, follow your process, okay? All right, thanks everyone, and on the way out here, I have to run the U.S. Legal Disclaimer. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.